Hello, in this lecture, we're going to define the term of accrued expenses. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of accrued expenses is costs incurred in a period that are both unpaid and unrecorded. Adjusting entries for recording accrued expenses involve increasing expenses and increasing liabilities. Let's break that down a bit. We're talking about costs that have been incurred. So under the matching principles of the accrual principle, that means if it's been incurred, then we should be recording the expense at the point in time that it has been incurred according to accrual principles. But at this point in time, it has been unpaid, whether that be by cash or some other means. We haven't paid the cash or some other payment yet, and it has not yet been recorded at this point in time. What that means is that the accrued expenses are something that we will need to adjust at the end of the time period. So we're going to have the cutoff date, we're going to make the recording entry. What are we going to do? Well, the expense has been incurred under the revenue recognition principles. Therefore, we're going to increase expenses, recording the expense, and we're going to increase the liability related to that expense that has been incurred but has not yet been paid. Let's take a look at some examples. One example could be a loan, interest on the loan. So if we have a loan out and we pay interest on the rent, just like if we were paying rent on an apartment or something like that, it may well be that the loan interest that we owe is not due as of the cutoff date. If our cutoff date is 12/31, it may be that the rent is due sometime in January, or we could pay the rent yearly every 6 months or something like that. Therefore, we will have used that money before the cutoff date, even though we have not yet recorded the interest expense and the liability related to it at that point. Therefore, as of the cutoff date, the adjusting entry would be to record the interest expense, increase in the interest expense, and record the related liability, something like interest payable for interest. Wages is another example. Wages, because it's for convenience for logistic purposes, we usually pay wages more on a cash basis rather than an accrual basis, with the plan of making the adjusting entry at the end of the time period. Because we're on a cash basis, it's very possible that as of the cutoff date, we may have wages that have been earned but have not yet been paid. For example, we might be paying someone in January for work that has been done at least in part in December of the prior year. Therefore, we need to record the wages expense as of the cutoff date that have been incurred at that time, and the related liability, something like wages payable. And another example could be IRS taxes. Taxes obviously are going to be incurred, income taxes at least are going to be incurred as we generate income. And that's another thing that we may not be recording the related taxes at the point in time that we generate the income. As of the adjusting process, we might say, okay, how much income has we earned? Therefore, how much taxes are we going to owe on that income? And then record the adjusting entry debiting some type of tax expense and crediting taxes payable, some type of liability related to the taxes that will be then owed.